We're facing forward. Thank you. Good morning. It's 8 o'clock, and this is the Gold Fix. I am Vince Lanci, your host. I actually have the charts up today, as well as the stream. So if I miss your question, that's because I'm buried in actually reading a script instead of talking. So why don't we get right to it? Let's start with gold proper, before we get into the drivers behind gold, and then the global news for the day. Well, that chart's populating up there. The Globex settlement is about the Comex settlement, I should say, is 1288.40 in February gold. The rollover is almost complete. If you remember the last couple of days, I've been speaking about this being a strong hands to weak hands. I still believe that, and I'm going to go with that. However, I don't know what's taking so long. I do have something else to add to that hypothesis, and that is, I think, and again, when I say I think, this is pure speculation. I don't even have any flow information to confirm this. I think that the Newmont deal with Goldcorp might have something to do. I opined the other day that the Newmont deal may have had something to do with the Canadian dollar's recent activity, considering it was a cross-border transaction. Why wouldn't that have something to do with the price of gold as well? And by that I mean, here we are, and I'm throwing this out there. This is actually more conjecture than speculation, based on the flows that I know that are out there. I just don't know who's doing them. But we have buying. We have a ledge on a daily chart that I've showed you several times, and we have a buyer keeping a bottom in, and we have a seller keeping a cap on the market. It doesn't mean that there's anything conspiratorial going on, but it does mean that if you're doing a deal, as they had been doing, probably piecing together for months, probably started looking at that right after the Rand deal. But when it came time to price the deal, if you look at the last 7 days in gold, it was in a wide range, but it was definitely in a range. And it's not unreasonable to think that we have a marketplace that wanted to support a low volatility price for the precious metal as they crossed their T's and dotted their I's on the deal. So conjecture, fact, there is a buyer on a flatline level. And for some reason, I'm not refreshing properly today. I'll blame Minecraft. I will take responsibility for my own actions. But we don't know who it is, and we are going to stick with it. The things that matter to us most, and I put this out on Twitter and maybe in the chat room yesterday afternoon, is that we do have a 4-hour signal coming up in gold, and the levels that I put out yesterday were not unlike the technical levels that I have today. I'm not showing you that report today, but I'm going to read a couple numbers off of it. We have 1294. That's a downwardly sloping line coming in on a technical side. If you're looking at an hourly chart, and we have 1288 in Feb futures below, and that's an upwardly sloping line. So active traders should be very careful of those numbers, and those numbers are really not that far away from what I have on a 4-hour Bollinger Band signal. So I'm looking for, in fact, we'd actually traded a 1-hour breakout yesterday higher, and we're stopped out rather quickly and abruptly, which I'm happy with. That's not a problem for me. The only problem is I didn't reverse. The other trade I had on was an S&P trade, which was completely disciplined in execution, but undisciplined in conception. And by that I mean the market had been flatlining. And we just talked about this the day before, that when the market's giving or offering you nothing, don't force a trade. And I put a little bit too big of a position on, I think, for that ES trade and suffer the consequences. I do remain short JP Morgan, which I'm probably getting hammered on today because Bank of America, I think, killed it on earnings coming out this morning. But back to gold. Okay, so you look at an hourly chart right now. That's Feb Gold. Spot gold is trading 1289.21. Add about 6 ticks to that. That puts about 1289.80, putting us right in between, right above the 1288 hourly support, and right and about $4 below 1294. I think, and this is based on my performance yesterday. I think based on my performance yesterday, it's best that I tread lightly. And this is a lesson, I think, to be shared with anyone who's had a bad day, or a day where they immediately knew they did something they should not have done, uh, and just be a little bit more careful in my trades. That doesn't mean I'm not going to trade today. It does mean I'll peel back on my volume, and I may tighten or widen my stops. I'm not really sure what would serve my gut risk management feeling best, but I do know that uh, I may not be more selective. I may trade actually more, but I will trade for less, uh, so that it doesn't matter. Uh, this way, I can just keep moving like any shark would without becoming stale. Uh, so anyway, the numbers in gold: 1294, 1288. I actually have a 4-hour Bollinger Band, not Bollinger Band. It's a volatility-based system triggered by Bollinger Bands. Uh, I could definitely get a false breakout below 1288. I really don't have anything except maybe 1285. But below that, if I were to get short, let's just put it this way: below 1288, I'm looking to get short. Below 1285, I will get short if I get a signal and it's on a 4-hourly bar on the VBS. My target would be 1276. On the upside, uh, I think it's safe to be long right here with a stop between 1285 and 1288. With a target of say 1294. If you're trading tight and you want to move on, you want to set it and forget it, so to speak. You're long here with a 1286 and a half middle at stop, and look for an exit in a 1294 area, or trail a stop if we get there, and look for 1300 above 1294. Above 1300, 1302 area, there are not a lot of numbers that I have. And by I mean, basically generally accepted simple rules of technical analysis. But that doesn't mean the market won't stop and reverse violently in between, say, 1302 and 1316, thereby establishing a number. And that's the problem with technical analysis. It's very subjective. So if I had to trade, and I don't have to trade, I would be lightly long above 1288 with a target of 1294. I would have a stop out between 1288 and 1285. I would get short. Again, these are trades if I had to do them. I would get short below 1285 if it coincided with a signal on my system for a 2-to-1 or 1.5-to-1 risk reward, with 1276 as an ultimate target. So if I got short at say 1284, and the system generates the stop. If I got a signal to be short and the market was trading 1284 with a system-based stop that would come in at say 1289, I'd be risking $5. So I'd be looking to make 7.5 to $10 at least, or I wouldn't put the trade on. And my stops should reflect that accordingly. Anyway, to the markets themselves, things that are driving a war from east to west. If you bear with me here, in Asia, China injected 560 billion yuan into the system last night. That's separate from the fiscal stimulus package they've been talking about. This may be a record for them, I'm not sure, but it's not inconsistent with them cleaning their plates or clearing their plates for their Lunar New Year. The Lunar Year is a holiday for government and historically a significant consumer season there, which to me, the editorial comment on that is, hey, big consumer season, trade talks aren't done. Let's throw some money out there to make sure that the consumers have liquidity to spend. More on that when we discuss the trade wars. It had its own section. Japan reported machine orders below expectations, and the Bank of Japan meets next week. The yen's recent rise may give reason for them to focus on lower domestic inflation. Uh, we have in Europe, well, May's Brexit deal was defeated. I almost said Brexit. That actually might be Freudian. May's Brexit deal was defeated, and most think she'll survive a vote of confidence. This doesn't simplify the Michigas. If you're not a New Yorker or familiar with Yiddish, that just basically means mess. That is Brexit. The EU Commission this morning stated it is not open for renegotiation. The next move has to come from London. So that's them putting a cap, or at least saying that they're going to put a cap on the insanity, and that they're not going to participate in anymore. Um, Translation to me, and I'll get more into this when we just throw a paragraph at this on Brexit, is that the Brexit deal, I think, Brexit's supposed to go into effect March 29th. Expect that to be kicked down the road a little bit, even if they don't want to, because you know if May loses her confidence vote, well, what's the alternative? And that means they're going to have to add some time to it, I think. In the U.S., the shutdown continues with some essential workers actually being ordered back to work without pay. I don't know who they are, but they must be important. Uh, maybe they're the guys in charge of making food based on the hamburgers. The Trump administration estimates that its hit to GDP is around 0.1% off of GDP per week. When you read things like that, if you have any respect for math, you want to ask yourself, it's 0.1% off of GDP per week. Is that 0.1% per week off of weekly GDP? The answer, I had to dig into that to make sure, was no. Um, uh, uh, from two different sources, just to clarify, because there's too much gray out there. It's 0.1% off per week off of an annualized GDP. It's still nothing to sneeze at. It's probably cost about, if you do that math, it's probably cost about point four off of annualized GDP. So that's no joke. But certainly, any numbers coming out of any administration, any political sphere, I have to look at with a little bit of a jaundiced eye, especially since they have a dog. Trump has a dog to fight in this in the form of the wall. Trade wars. After a multitude of assurances, things were optimistic and that progress was being made. The U.S. Trade Representative, I can't even say his name, Lighthizer, admitted that there was little progress being made. Surprise. China's playing the waiting game. We find the timing of his frankness coinciding with China's own announcement the night prior of increased stimulus, not a coincidence. Uh, Given that the China QE, basically an acceleration of their QE announcement, is a sign of further digging in for the long haul. And if this doesn't complicate things enough for Trump, who thrives on confrontation, and that's his shtick, that's his MO. Like it or hate it, whether he's good at it or bad at it is it remains to be seen. But when you look at a person who picks fights, as a person who does pick fights, okay, as a trader, especially on the floor, I was pretty confrontational, and it was actually an homage to Fibro, in the sense that as a negotiator, good or bad, Trump pushes on a wall, and if that wall gives, he's in a little 4x4 cell, and he pushes on a wall, and if that wall gives, he's going to keep pushing. Well, he's pushed on the four walls many times, and most of them push back. Um, and he's having a hard time, I think, putting more and more unclosed confrontations on his plate. What I'm leading to here is we have trade talks with the EU coming up on deck. And what started as probably not a bad idea tactically to accelerate a trade talk or trade war with China because of the, uh, uh, I won't call it fake, but because of the optimistic outlook on NAFTA 2.0 or whatever it's called now, that might have been a good tactical move. But to think that China would capitulate before his presidency was up for reelection, I think would be a major faux pas. And now that you have NAFTA 2.0, is not done, although all signs are that it will be done. You have China that will not capitulate to the U.S., even though the U.S., as an aside, did the right thing tactically, because well, this is a conversation about the dollar and why you should just be long gold in general. Um, the timing of the Trump administration's uh, trade war, I think, is actually appropriate, because our economy was strongest against the world's, and it would, if there was any time to force hands on the dollar as reserve currency, now was the time. And what it's doing is it's splitting the world into two trade zones, with Europe in the middle. So my digression aside, the EU trade talks with the US are going to be coming up soon. And it would seem another can of worms, or another can of worms on his plate, to mix metaphors, will be open for the administration, especially in grains, where I think there is going to be a problem. Our historical alliance with the European nations, based on protection and NATO, is not as important as it was. I'm not saying it shouldn't be as important as it was, but Europe is focusing on the East and the more geographically easier access to supplies like natural gas, like maybe they're going to be buying Russian wheat. So these are all things that I think augur for a weaker dollar in years to come. I think it would be a mistake to think that the dollar is going away tomorrow. But I do think that, consistent with uh, the macro concept of why gold exists, or why gold is needed as an asset, gold's not an investment. This is almost something that should be on part of my tombstone. Gold is not an investment. Gold is not something that you buy expecting a rate of return on. Gold is money. Uh, it may be other things, but it exhibits the qualities of money. It can neither be created nor destroyed. So don't give me that it's limited above ground stuff. There's not really much of it out there. There's also none of it that's been destroyed. And gold is a non-rusting, non-depreciating, in the sense that it degrades, uh, hedge for the dollar. So if you own dollars, you should own gold. And that is your time length. Do you have a dollar that you're going to spend? Do you have a dollar that you're going to earn? Then you should own gold. How much? I don't know. I have no. I have. It depends from person to person. There are people say 5 to 10%. I mean, to throw numbers at people like that, I think is not genuine. But I've actually seen the efficient frontier to be as much as 15%. If you look at a chart on performance versus other assets on an efficient frontier curve last year out of CPM Group. So my point is this: if you think your house is a hedge for inflation, and you think inflation is coming, or inflation is here, uh, it's not. Your house is not a hedge for inflation, because if your house does keep pace with inflationary pressures going forward in the future, you're not going to be able to take a home equity loan on it. I think the odds of that are very low, because at the moment that you need the money the most is the moment when the collateral you need on your house needs to go up, and the interest rates that they charge for you to take home equity loan out on your house to buy bread and that GI Joe with Kung Fu grip are going to be prohibitive. I know this from experience of watching the Argentina crisis in 2001 and having friends deal with it down there. Your house is not going to be a hedge for inflation. Your house should not be viewed as a piggy bank in an inflationary environment this time around, because the banks are not, they're going to tighten the noose. Anyway, so we like gold above 1288. We don't care about gold between 85 and 88. And we hate gold between below 85. That said, we'll be light on our trading. Prefer to sell it below 1288 on a 4-hour close, then buy it right here looking for 1294. That might be because I did that yesterday and was stopped out. Once bitten, twice shy, but it doesn't mean I won't do it again. So it is 8:20. U.S. stocks are They were flat when I looked last, probably stronger after the Bank of America, but I'll have to check my own setup on that in a second. Uh, Keep in mind, also, I want to add one thing. I want to add the European thing. May's Consider this: if you're trading today, if you're an active trader, some trading thoughts down on deck. If May loses is the confidence vote, don't be surprised if cable weakens substantively. Either way, we feel the Brexit bucket will be kicked past the March deadline. The Fed beige book is due out today, and the dollar is sideways. I think there's a lot of people out there in the equity markets that are licking wounds and being told to sit on hands, and because of that, the hangover in volatility losses is flatlining the market a little bit. And active traders should trade accordingly, not like I did yesterday. If there's no opportunity, don't force it. The market will always be there. This is Vince Lanci. Have a great day, and stay tuned for the 8:30 a.m. roadmap with Larry, and I'll be joining him as well. Thank you.